All right, so now we're going to look into more detail on how common stock works, the journal entries for it, and how we issue it. So let's look at our first part. So issuing par value common stock. So we're going to start with par value, and then we'll look at stated value and no par value. So when we look at par value stock, the example they give here says on June 5th, Dillon Snowboards Inc. issued 30,000 shares of $10 par value stock for $12 per share. So to record the transaction, we got to think back to accounting 1, how we do journal entries. Don't forget, you still have to do that. Then we're going to be looking at what kind of accounts are we adding in here. What are our new accounts? So one of our new accounts is going to be common stock. That is going to be a stockholders' equity account. We also have paid in capital in excess of par value for common. And then we have to look at the asset that we're receiving for issuing that stock. So in this case, it tells us on June 5th, Dillon Snowboards issued 30,000 shares of $10 par value stock, but they issued it for $12 per share. So they're issuing it for more than the par value. So that's where that paid in capital in excess of par value comes from. So the par value is the amount that goes into common stock. That's the $10 value times the number of shares. The paid in capital is in excess of par value is how much was over the par value when we issued it. So it's $10 par value, $12 per share. So there's a $2 per share difference. So $2 per share times 30,000 shares is going to go into that paid in capital in excess of par value common. So the first thing we have to look at is, okay, we're getting cash for this, right? We're selling it for $12 per share, and we issued 30,000 shares. So 30,000 times $12 per share gives us $360,000 cash that we're receiving. So we're going to debit cash for $360,000. We're going to credit common stock for the $10 par value. Only the par value goes in common stock. So $10 times the 30,000 shares issued gives us $300,000. Next, we have paid in capital in excess of par value. That is going to be that $2 difference. So $2 times the 30,000 shares gives us $60,000. So that's our entry to issue it when we issue it above par value. All right, so now let's see that entry. How did that change our stockholders' equity section? What does it look like? So before, we had one capital account, right? When we had a sole proprietorship. With our partnerships, we had 2 or more capital accounts. With a corporation, we don't have capital accounts per se. We have common stock. And then the capital we receive above that common stock par value, that's our paid in capital in excess of par. So we see it reported on our stockholders' equity section like this. So in this section, we're going to see common stock listed. That's our equity. And paid in capital in excess of par is also an equity account. The next one down, retained earnings, is where we actually hold the earnings or the net income from the company. So if we had a net income, we're going to see retained earnings increase. If we have a net loss, we're going to see retained earnings decrease. But those are the basic accounts we're going to see in that stockholders' equity section. So here we can see that we issued 30,000 shares for a total of $300,000, and we had paid in capital in excess of par of $60,000. That amounts get put into our stockholders' equity section. In this example, we had retained earnings of $65,000. We add all of that up, and that gives us our total stockholders' equity. All right, so that's how we look at it if we received cash for issuing that stock. But sometimes, like we saw in partnerships, people gave us other assets instead of cash to gain ownership in the company. So this next example, it says that on October 20th, Dillon Snowboards Inc. issued 1,000 shares of no par value stock for $40 per share. Let's record this transaction. So in that one, we're looking at a no par value. So if it's no par, remember that it's based off how we issued it. So if we issued $40 per share and it was 1,000 shares, then that's $40,000. So we would debit cash for $40,000 and we would credit common stock no par value. All right, if it's stated value, then we're going to have this example, and it says Dylan Snowboards issued 1,000 shares of $40 stated value stock, but they issued it for $50 per share. So to record it, we have to, again, we're debiting cash for that $50,000, which comes from the price they're selling it for, $50 times 1,000 shares. And then we credit common stock for the par value or stated value, $40 times 1,000 shares. That's where that $40,000 credit comes from. And then paid in capital in excess of stated value, because instead of par value, it's stated value. We have a $10 difference, so $10 times 1,000 shares is $10,000. All right. This example shows us that on June 10th, 4,000 shares, a $20 par value stock was issued for land that was valued at $105,000. So instead of getting cash, they gave us land that had a value of $105,000. And in exchange for that land, we're going to give them stock in the company. The stock had a $20 par value, so we're going to look at how many shares we're giving them. We're giving them 4,000 shares, so that's going to be $80,000. That's a credit into common stock. The difference between $80,000 and $105,000 is going to be the paid in capital in excess of par value. So 105 minus 80,000 is 25,000. So we gave them shares of stock for land. All right, the next section goes into looking at how to record cash dividends, stock dividends, and cash and stock splits. All right, so the thing that we see most commonly is a cash dividend. That's basically where the corporation is paying out cash to their stockholders. This payment of dividends definitely can affect the value of the stock out there in the market. If a company tends to pay higher dividends, then that stock is going to be worth more because the investors are going to get their money back in the form of dividends. So the decision to actually pay the cash dividend comes from the board of directors, and it has to be based off of looking at what amount is in retained earnings, making sure it has a sufficient amount of retained earnings, and then do they have the cash available to pay out that dividend? So both have to be taken into consideration. Typically, corporations are paying these at regular dates. They might pay them quarterly, they might pay them semi-annually, they may pay them once a year, but they're considered cash flows, and that's providing a return to the investors, and that's why it's going to affect the market value. So when it's time to declare a dividend, there are 3 important dates we have to look at. The first one is the date of declaration. That actually is where we're going to do a journal entry to record the liability that we're going to owe when it's time to pay out the dividend. So the board decides, hey, we're declaring a dividend. At that point, that creates a legal liability for the corporation to pay to its stockholders. So we're going to do an entry to record that liability to set up for a dividend payment later on that date of payment. Now our second important date, there's no entry required for it, but it is a very important date. It's called the date of record. That decides who gets that stock dividend. So as I said before, stocks are bought and sold pretty frequently. Whoever owns the stock on the date of record is who will receive the payment for that dividend when it's time to pay on that date of payment. So if you sold your stock the day before the date of record, you don't get that dividend. Whoever you sold it to would get that dividend. So the last important date is the date of payment. This actually does have another entry, so it's going to show us the actual payment of that liability that we created on the date of declaration to pay out that dividend. All right, so let's look at a cash dividend. So it says January 9th, there was a $1 per share cash dividend declared on Zetec. They had 5,000 shares outstanding. The dividend is going to be paid on February 1st to stockholders of record on January 22nd. So January 9th, the board decided to declare a dividend for $1 per share for 5,000 shares. The date of record is January 22nd, so whoever owns it on January 22nd will get to have that payment. And then we'll actually have to pay it out on February 1st. So let's look at that. So our first one is the date of declaration. That's where we're recording a liability. So the liability is going to be common dividend payable because we're going to pay out a common stock dividend. Dividends are paid out of retained earnings. Retained earnings normally has a credit balance. So to reduce retained earnings, we're going to debit retained earnings. We're going to credit that liability account, common dividend payable, for that amount of $5,000 that comes from $1 per share times 5,000 shares. All right. The next part is January 22nd is our date of record. There's no entry that's required, but whoever owns it on that January 22nd is who will get the actual dividend. The date of payment was February 1st. So that's where we're actually going to reverse that liability and pay it out in cash. So we're going to debit common dividends payable and credit cash because we're making a payment to our stockholders. So we're clearing out that liability that we owed for $5,000 and we're paying it out in cash. All right, sometimes we can have a retained earnings deficit. If this happens, it's usually from companies having losses over a period of years or companies paying out dividends that are greater than the profits that they've earned in those years. That's never a good thing, no matter what the situation is. So we have to make sure that we're cautious in issuing dividends to make sure that we have enough retained earnings to support our business. All right, our next section will look into stock dividends and stock splits.